A lot of information released this week for Alibaba that shows that there are signs for some strong growth over the next 12 months. We're going to take a look at that. We're going to take a look at the Chinese data that was released as well as the stimulus. We're going to take a look at how the markets really liked what the Chinese PBOC performed, as well as take a look at Moody's, who did cut China's credit outlook over the foreseeable future. And with this information, we are going to run Baba through our extensive valuation model to get to the updated intrinsic value and acceptable buy price given our investor margin of safety. Now we can start off with this company. Now we know it has been hammered. We know it's towards its 52-week low. And for those that are new, it is offering a yield, which is something that only happened this year. But the real interesting thing about Alibaba Group Holding is that it is down around 80% from its all-time highs, which for those that don't know is around 24% below the IPO price in 2014. And since that point in time, their revenues have grown over 11 times, their profits almost 5 times, and not only do they have a market cap around 190 billion, and we're going to touch upon this shortly, they have a very large cash position of around 80 billion, bringing in around 24 billion worth of free cash flow per year. So let's take a look, see whether or not this is incredibly undervalued and what issues lie ahead. Now, top line very quickly, for those that are new, we look for 3 to 7% growth year on year. What we can see for Alibaba over the last 5 years, they have effectively more than doubled their top line from 56 billion to 126 billion. Yes, we can also see that it has gradually increased year on year up to 2022 before dropping, but still over the last 5 years, that is some phenomenal growth by this company. In terms of the bottom line, again, we do see some growth, 13 billion in 2019. It does grow up to 23 billion in 2021 before dropping down and then increasing slightly. Although we do know, based on the trailing 12 months, we do believe that 2024 will be a strong year for Baba. So they have increased their top line. Their bottom line, whilst not increased year on year, is still moving in the right direction and is still a significantly healthy figure. In terms of their balance sheet, a quick health check. Well, their cash position, as well as we mentioned earlier, it has increased from 30 billion in 2019 to around 80 billion or just shy in their latest quarterly report. And when we compare that to their total debt, well, in actual fact, numerically and directionally, we can see that the amount is very small in comparison to their cash. 20 billion in 2019, 27 billion from their latest quarterly report. So this is a very healthy company when we analyze it from essentially the balance sheet. Now, what we can touch upon was Moody's. Now, what they essentially have done is cut China's credit outlook due to effectively the negative rising debt risks, and the very big headlines. What we can see is they have moved it from stable to effectively negative, and there are a few reasons for this. Essentially, they expect Beijing's support and the possible bailouts for distressed local governments, as well as their state-owned enterprises, to diminish China's fiscal, economic, as well as institutional strength. So they do see a lot of risks with China investing at the moment, and this will have obviously affected investors and their decisions to effectively invest in this company, as well as the Chinese industry as a whole. In terms of what we can see here, we can also see that China's liquidity boost does really help the market over last week. And effectively what they have done, the People's Bank of China, PBOC, they offered commercial lenders around 800 billion yuan. For those that don't know the conversion, $112 billion. 1 year loans, more than twice the amount that was estimated by the analysis. So this was a very large amount which essentially was pumped into the market. And as we can see when we do take a look at this article, a lot of stocks did rise from this information. We can see Baidu stock up 1.7%, Baba up 3.2% on the week, and JD up 5.2% in the midday. And these are companies that effectively did essentially have some very good news. Based on that, we do see in actual fact over the last 5 days for Alibaba, it was up 6%, but we can still see it is still right there at that 52-week low or very near. And again, this is a stock that over the last 10 years we can see hit its all-time high at the end of 2020 at around $310. So if this is expecting to go up to its all-time high, there is a lot of room for growth. But the question is, will it or won't it? Now, in terms of the broadline retail industry in China and other industries globally, when we take a look at their performance year to date, we do see Alibaba one of the worst performing, down 19%. We see Meli, which is one we will analyze on the channel soon, up 94% year to date. So there are a lot of industries out there and a lot of companies within these industries that have some very, very strong performances year to date. When we look at the last 5 years, again, Alibaba, one of the worst performing, down 48%. Again, Meli, one up 417%. So it isn't something that is restricted to the industry, but it does seem that in this case, China isn't a play over the last 5 years that has been profitable for investors. We see JD, another company in the industry, up 33.6%. Now, in terms of the dividend safety, now this is a company that has just started paying dividends, so we don't have a score just yet. The yield is around 1.32%, and Alibaba currently has a market cap of 190 billion. Now, when we do take effectively a look at what that free cash flow payout is meant to be, it is looking very low at around 10-11%. Now, typically, I like to see a maximum of 60%, as it means that management will have the ability to offer double-digit increases. Now, when we did look at their balance sheet, we did see the very, very healthy amount they have in terms of cash. In terms of their total debt as well, it is a very strong amount, a very healthy balance sheet. Given the fact that the payout is incredibly low, I would expect as an investor for the dividend to grow very strongly over the next few years, or if not, to at least see some very strong and healthy buybacks by the company. Now, we have reviewed this channel before, so if you do want to see in-depth analysis, not only on the company, but also the news where we go around Jack Ma looking or intending to sell his shares, do check out the previous episodes. In terms of free cash flow, well, this has grown very, very strongly over the last 10 years. You do see that dip to 2022, but it has not only picked up, but is expecting in 2024 to go up slightly higher, 984 to 63, so around 6 times growth over the last 10 years. Very strong to see, especially from a company that is continuing to increase. Now, sales growth, double-digit increases, we always love to see this, but remember, with this, the risk that I personally see is that it has grown double digits year on year over the last 10 years. 2023, it has slowed down to around 2%. Is this something we are expecting, or is this something that is a one-off and we should expect double-digit increases over the foreseeable future as well to continue the growth of this phenomenal company? 52 billion in 2014, 869 in 2023. Now, shares outstanding, 2.33 in 2014, 2.64 in 2023. So they do share issuances, in fact, where they have diluted your position as a shareholder over the last 10 years. And when we do come and look at the valuation of this company, surely we will see that it is a slight surprise while they haven't started to do share buybacks aggressively, given how undervalued this current company looks. Now, ROIC, personally 10% or more, as we always say. Management then have the ability, in our opinion, to effectively allocate their capital, so it gives us faith. Personally, I could be satisfied with this consistently around 8 to 12%. And when we take a look at the margins, very positive to see, very strong numbers, above that 16% on average that we like to see on the operating margin, and well above that 7% on the free cash flow. But just a few things to consider moving forwards. Both operating margin and free cash flow margin have started to deteriorate. They are on the decline, as well as what we saw on the sales growth. So again, you have to ask yourself, as one of the risks to this company, alongside the Chinese regulation and the other points that we targeted at the beginning of the video in terms of Moody cutting their forecast on the China economy, is this a company that, as we can see, based on not only their operating margin and free cash flow margin, but also their sales, is it starting to slow down in terms of that growth company that it once was before? Or is this just something that is a temporary blip on the progress of the company moving forwards? Finally, in terms of the metrics, net debt to EBITDA, the strength of the balance sheet, the strength of the dividend, essentially showing us the number of years it would take the company to pay off all of their debt net of cash on hand. This is coming to effectively zero, showing that it wouldn't even take them 1 day to pay all of their debt net of cash on hand. Very quickly then, institutional ownership sitting around 14%, around 6 billion worth of sales by these institutions over the last 12 months, with 9 billion buying over the same period. And what we can see in Q3, the latest quarter of 2023, more buying significantly by the institutions than selling, 2.1 billion than 765 selling. So always you can consider this within your research, but never base your investment decisions off what institutions are doing, and always do your own due diligence. So as we can see, they haven't had the greatest performance over the last 10 years. Yes, they did hit their all-time high, which is significantly above the current trading price. But let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe button and bell button so you are notified of these videos as they drop. And do click on that pinned comment below if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. Now, or even in fact not just your portfolio but also on your watch list. So let's jump into Graham's valuation. We have the stock ticker, the earnings per share, we have the growth rate per analyst estimates and that current yield on AAA corporate bonds to give an intrinsic value of $110. Now when we compare that to the current trading price, we can see that is some significant upside to $74, which it currently sits at, but slightly lower than the 52-week high. So we do see our first sign of undervaluation, bearing in mind we're not looking at any of these models in isolation, and we will draw conclusions towards the end of the episode. We then have the multiples valuation model. Here are the companies similar sector and size that we analyze with their PE. We get the average PE multiplied by the earnings per share to give a bar stock price based on the multiples of 144. As we can see, this is well above the current trading price, in fact around double the current trading price, so showing signs of 100% upside based on that one model alone. We then move on to the dividend discount model. Now yes, they are starting to pay a dividend, but given the fact that we don't have a lot of years worth of data, this isn't one we will include in our final calculation. We then move on to the third model. We're using the DCF model, the discounted cash flow, with our free cash flows year on year. Average growth rate at 30%. Now forward looking, we have gone conservative, more conservative than effectively also the analysts. With that discount rate, we get the present value of these future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of 245. Now this is well above that 52-week high. And as we can see though, it isn't above the all-time high. So we are saying based on the DCF model, there is a lot of room for growth to the current trading price and some significant upside. Now the intrinsic value for Alibaba is essentially the average of the three models that you see that we've run through, and we get an intrinsic value here of 166. Now as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now typically we start off with a 10% margin of safety if we believe it has a wide moat, strong financial metrics, good forward looking data, and we can see that would be a buy up to 149. Now the current trading price is significantly lower than that, so if we start off with 40%, we can see it is still a buy. At 50%, still a buy, and if we go to 55%, we can see pretty much at the current trading price. So we do believe the margin of safety for Alibaba is at a 55% margin of safety. In terms of Wall Street, what they believe, well, they also see some significant upside, with a lot of analysts even believing it to go higher over the next 12 months, so they do believe it to be a strong buy right now. As we can see, this margin of safety really does depend on what you see the potential risks over the future for this company. In previous videos, we have a ton of comments saying that they wouldn't touch Alibaba for a significant number of risks around Chinese regulation, the Chinese economy itself, as well as the fact that a lot of people believe that some of these numbers are inflated. As always though, do let me know your thoughts below. Is this one you are looking to add? Is this one in fact maybe you're looking to sell, as you've held it for quite a long time at the all-time highs? But personally, this is one that I will be looking to add at some point. It does look like it could be a very good play for the long term, but it is also a lot of risk. So it isn't one that when I do allocate to the portfolio will be more than 1% or 2% of the portfolio. But I do understand that there are a lot of risks with this company. So always do bear in mind not only the upsides as we do discuss on the channel, but also the risks and the downsides. As always, let me know your thoughts in the comments below. If you enjoyed the episode, smash the like button, hit the subscribe and bell button so you are continually notified of these videos. And don't forget to click on that pinned comment below if you want to grab a copy of the valuation model to run not only your own companies through to get your intrinsic value and acceptable buy price, but also companies in your own portfolio and watch list. As always, have a great day and catch you on the next episode.